again, I'm Crystal Budd from Health Plans for Less, and I'm going to share with you about some information on long-term care. There's a saying that's been said many times: is if you don't have long-term care, then you believe you have the ability to self-fund your own care on your own. And so long-term care is not for people that don't have a lot of assets. If you don't have a lot to protect and you end up in long-term care, you will spend those assets fairly quickly, and then you'll basically belong to the state on a Medi-Cal program, and they'll decide where you go and how you'll receive your care as you live out the final days of your life. The average long-term care stay is about 3.5 to 4 years. That's not to say that you could be 10 years in a long-term care facility, especially if you have dementia or Alzheimer's and maybe you're super healthy, except for that one element of your life. And I've seen that before. So this was actually a client of mine that purchased this product, and I thought, what best way, this is the best way for me to show you this is how it works, okay? So the first paper I want you to have a look at is the one with the buckets on it. This page here. Okay, so this, I think visuals are really helpful for people to understand things that can be a little bit complex by nature. And a lot of times you talk about insurance and people's eyes glaze over. And they're like, I don't understand, I don't want to talk to anybody, is it good? Is this going to help me? So this is a really good product. I like this product because it's called a single premium life insurance policy. This individual had $100,000. She wanted to, what I call, do an asset transfer. So don't think of it like I'm spending $100,000. Think of it as you're reallocating an asset. You know you have this money, maybe it's in an IRA, a 401k, a savings, a bond, I don't know, it could be some investment vehicle. You're aging, you're thinking most probably I'm going to use this for care, an emergency situation, maybe it's going to be long-term care, it could be one of those emergencies. So you take the asset and you move it to another bucket. You reallocate it. So I like the description of these buckets because I think it's a good visual. So you don't think I'm spending this money and I'm never going to ever have access to it again. You're just reallocating it. And what it's going to do for you, it's going to give you a much greater value should you need long-term care. So is that a good thing? Especially as we get older and we start realizing our mortality, and we start thinking about, do I want my children to be the ones that make the decisions and care for me? Do I want the state to make the decisions and care for me? What do I want? What's important to me? If you have any assets at all, when you get over about $1.5 million, then you really need to start thinking about protection, because you will spend your assets down in the end of your life if you end up having a health issue. It's expensive. I have a friend that has two parents. The mother just passed away. They were in their 90s, and they were both in long-term care. Very expensive. And they do have long-term care now. It's helpful. And they had caregivers coming in around the clock. Very expensive. So they were prime people to talk to about. They made some really good, the parents made some really good choices, and it really helped support what their needs were. And they stayed in their home, which is pretty unusual too, because they were able to get all the things they needed. Yeah, that doesn't mean they went in and out of skilled nursing at different times for different needs, but the majority of their time they stayed at home. So, okay, so this is an individual that reached out to me and said, I have this asset. I am thinking I'm a single woman. I don't want to put the burden on my children. I want to make the decision for myself. I want to have a plan. And so she says, what can I do with this money? So this happens to be Lincoln Financial. They're a high-rated company. I only use A-rated companies. I don't deal with B-rated because that's just my conscience, how it serves me. That's where I would put my money. So I do the same for my clients. So what happened here, now she was 73. She's a little on the older side, right? So you're not gonna get as great a benefit. But if you take that 100,000 for a 73-year-old female, she turned that 100,000 into $198,146 of long-term care benefits. So essentially, she doubled her money, that asset, immediately once the business was placed. Okay, so she took that 100,000, did an asset reallocation, and now she has that amount of money accessible for long-term care. It basically provided a monthly benefit, you'll see there, for $4,128, okay? Providing at least 4 years of coverage. That's what that would break down to. If she were to pass away before we're using the benefit, she would have the death benefit is minimum initially on the second page, I want you to look at this, it shows if you put in 100,000, your death benefit for the first year is 136,000. Okay? So if you look at that, if she were to die in the first year, she would take that 100,000 and get 136,000. Now what it does for that's if she died, is she gets that money tax-free now.
She doesn't get it.
Well, her family. Essentially, her family will get it. She doesn't get it. I stand corrected because she would be passed on.
I know what you're saying.
But the point is, you can take that asset now, and she just gained 36% on her money tax-free. So she really gained more than 36%, didn't she? Because if you had to run that through taxes, what would it be? Another 30%. She made it around 60%, right? So for her, and again, that's not what she wants to do is die. That's not the end game here. Next year, right? So the point is, she can have the death benefit, which will serve her family as a legacy, if she never uses long-term care. The issue with traditional long-term care is, if I don't use it, I lose it, like so many other insurance policies. They're protection. But if you, that's why I hear what you're saying, Dr. Salo, about I have a problem with insurance. I spend all this money, and maybe I use it, maybe I don't. Well, this is a policy that gives you what I call a bell and whistle, where if you use it, you get double. And if you're younger, sometimes we can quadruple that. Take 50,000 and turn it into 250,000 if you're like 50s and you're 55. Okay, so the younger you do that and reallocate the asset, the more bang for your buck you're going to get. Makes sense, right? That's how the insurance company works out the actuarial figures. All right, so that's a win-win. Another thing they offer is, in that third bucket, you see where it shows 80,000. That's, and it says ROP. That means if I decide I have buyer's remorse, a year from now, or they say, you're gonna die in 6 months. You have terminal cancer. And you're like, that's it, I'm traveling. I'm not doing any treatment, I'm leaving. You know, I'm gonna go travel the world, I'm taking it. I need money, where's my cash? You can take this policy, cash it out at 80,000. It's called return premium. You lose a little bit of your asset, but you have access to it. Take your money and run, go do whatever you got. Now, most people probably would say don't do it from that policy unless that's the only asset you have. I'd say find the money elsewhere, let this go to your beneficiaries, tax-free. That'd be the smarter play. But if you had no beneficiaries and you said, I'm going to take the money and run. I'm going to Paris, I'm going to Tahiti, I'm going to live it up for 6 months, or as long as my health will let me. You know, people do that stuff. That's a reality. So that is an option, believe it or not. You can get all your money out of the product. So to me, it's a win-win for the client. And I love that because I've had clients, one just called me, and I did not sell her this. She's a client, a Medicare client of mine, and she said, I have this long-term care policy. I've been paying about $3,300 a year, and now they're telling me my premium's gonna be $6,000, over $6,000. Do I have any recourse? And I said, no. The reason is that they can change the rates. It's all about consumption. If all of a sudden, with COVID, people living longer, people going into long-term care, if they're paying out a lot more money, what do you think they got to do to keep the policies in place? They got to charge more. I mean, it's just the numbers game, right? So that's what they end up doing. And so what happens is, if you buy one of those policies that's $200, $300, $500 a month, and what drives that premium is the coverage. Do I want $200 a day? Do I want $300 a day? Do I want $10,000 a month? You know, you figure out what you want, or you tell me I can afford X amount. I can work it backwards or forwards or however you tell me what I need, or you tell me this is how much money I have, and we'll find out what that will buy you. Okay, so we can work it from either perspective. So you can see this investment is actually a very good one if you're really considering not self-insuring, taking care of yourself, or having your kids take care of you, or selling off your home. A lot of people say, I'm not going to give this to my children, my home. It's virtually paid off. If I had to, I could sell my home and I could pay for this. And that's a fine plan if that's your plan. But you need to have a plan. You need to have some kind of plan in place. And again, I sell monthly policies too, but what happens there is, if she can't afford to pay that premium, she basically loses the coverage. All she gets is what she put in it. They'll guarantee the amount of money she put in, but that's it. If she fails to pay more premiums. So, and that means she might have bought, let's say she bought $6,000 a month, and now maybe she's only put in $50,000. You know, and that's all she'll get to use. So let's say this person was able to stay at home. $4,000 is a fair amount of money a month, but it could be a lot more than that, depending upon their needs. But let's just say they were able to stay at home, and they only need $2,500 worth of benefits, but their benefits is $4,100. So they don't have to use it all. They can defer that, use what they need, and it'll extend it out beyond 4 years. So that's great. You're not saying, we're going to give it to you no matter what. Because some people live longer, some people live shorter. They don't know, right? So I love that. This policy also doesn't have a third-party administrator that makes your decisions. Traditional long-term care always involves a third-party administrator. We got to go in to assess your health. What triggers it is if you cannot do 2 daily living activities. What are those things? It would be like bathing yourself, being able to go to the restroom, bathroom, having issues with continence, being able to feed yourself, being able to, what about this here? Feeding yourself, bathing, dress yourself, and then also transferring, like being able to move from one place to another. If you can't do 2 of those daily living activities, just 2, then that becomes the trigger for a potential long-term event where you can apply for coverage. There's called an elimination period. That elimination period is typically 90 days, meaning the policy doesn't kick in for at least 90 days. It's very standard. You can buy a shorter term, but there's a cost involved. So the traditionalists, and the reason I say that is most people on Medicare, they get ill, they end up in the hospital, and what happens is hospitalization is covered 100 days in the hospital or in skilled nursing under Medicare policies for virtually very little or nothing. So by that time, if you're that sick, you're going to have to be transferred to some kind of care, or you're going to be paying for it yourself through skilled nursing or a long-term care facility out of your own pocket. So that's when long-term care typically kicks in, is when Medicare is used up to that point. So another feature of this policy I like, as I was mentioning about the third-party administrator, is if you have a physician, your primary physician can help make that decision if they say you're no longer able to do these daily living activities. It's not somebody else coming in to assess you. It's your doctor. And that's huge. You can also use not your own children to pay for home services. But I could use my grandchild when I get older. If she grows up to be 18 years old and wants to come, I'm gonna need help. She could come in and cook for me, clean for me, pay my bills, take care of housekeeping, and we could pay her. I couldn't pay my daughters, but I could pay my grandchildren. And they don't have to have any qualities, or you don't have to qualify for any of those, just be able to do them. Right? I don't have to have a certificate. And that is huge when you want to be with if you want to be at home and you want to bring in somebody to help you. Maybe you want to die in your home. You do not want to be in some facility. And you want to have your family with you. And you want to have your grandchildren with you. That's a beautiful way to go. That's what I choose. So, okay, it covers adult daycare for those people that have dementia or Alzheimer's. They may be in great health. They have adult daycare that they go to every day. Okay, and they may come home at night, but you can take them out, and they will watch them and work with them and be out, so they're not just sitting in a chair doing nothing all day. So that's a wonderful service. The home health care, they have hospice services are covered under this, nursing facility care for services, residential care services, and respite care. Respite care is when the caregiver needs a rest. That's what respite care is. So if I'm a caregiver and I need to be off for a couple of weeks to get away for a vacation, they take care of that. They allow you to use the money for that. They also do home modifications. They have a certain amount of benefit for that. If you need a wheelchair ramp or a door widened or something put in your shower, a seat, a rail, whatever. They want to make your home safe if you end up in a long-term care situation. If you should use all of the money that's there after 4 years, they have a small death benefit that they will always leave with this basically for burial purposes. It's it's either $10,000 or 5% of what's left in the policy for burial purposes. So it would never be less than $10,000. So that's nice. You know, you might use all of your benefits, but they give you this as a gift, like to say, you know, when it comes time, there's $10,000 for you to spend to take care of burial services. So all that being said, I love this product. I thought when they came out with it, it's super consumer friendly. They thought of all the potential things that a person would need, and it's a way to take your dollars and stretch them and give you more bang for your buck. You do have to qualify. It's not just something, I want it, can I have it, I'm going to buy it. You have to go through underwriting. They do run your MIB. They also do a phone interview for about 30 minutes. It's a cognitive interview. They check to see how well you respond to things. Can you answer questions? They may reiterate another question. And they don't try to trick you, but they actually ask you questions where they know you're thinking. Because dementia and Alzheimer's is what they cover. So, as well as illnesses. So, I hope that was helpful to you today. And I know it's a topic we don't like to think about, but it is a necessary thing to think about as we age. And I will open it up for any questions.
Okay, first question. So if you want a husband and a wife on the policy, you really need to come up with about 200,000.
Well, I had a husband and wife, they only had 100,000 between the two. Statistically, women live longer than men. So what we did is we did a 60-40 on them. We did 60 on her and 40 on him. There's a minimum base based on the age of what you can write. So if we just have to, again, play with the numbers. And no, you can do all of it on the female if you statistically think, well, if I'm here, I can take care of him. You know, I can take care of him statistically. The women live longer. Maybe you put the bulk of it on the female. Because when you look around in facilities, you see a lot more women than men. So that's not to say men don't need it. They do need it. Because the burden will fall on the spouse or the children.
Because, the woman might want to ignore her husband for a while.
And another thing is, it didn't get it done for them. It wasn't enough, but it was something.
Yeah.
It provided them maybe $2,500 a month or $2,000 a month. It's still better than nothing. So that's what I tell them, and I have instances where you can do a 5-pay. For example, let's say you have an IRA and you don't want to take out $100,000 and have a tax hit. We could do 20,000 a year, look at your tax situation, it's still gonna, let's say it triples your money, it's worth you paying tax on that money over a 5-year period at 20,000 a year. Or maybe it's 10,000 if you wanna do 50. Anyway, we can look at all the numbers and see what makes the most sense for you. And that's what we do. So, any other questions? I'm way over, I'm sorry. It's really important stuff, and I'm sorry I went over, but anyway, I hope it was helpful to you.
Yeah.
Thank you.